welcome to the CNBC TV 18 special. I'm Farah Bukwala Vora, and today I'm in conversation with Mr. Saugata Gupta, the Chief Executive and Managing Director of one of India's leading FMCG companies, Marico. Thank you so much for speaking to CNBC TV 18. Let me start by talking about Marico's trajectory. Today, Marico is a 5,000 crore plus company, and by 2018, you're looking at garnering revenues of about 10,000 crore rupees. As you go along this path and try and achieve these revenues, what would serve as pillars of your growth over the next 3 to 4 years?
So I think the way we have been looking at is, if you look at our past track record of delivering around an 16 to 18% top line and a 16 to 18% bottom line, we want to first maintain this track. But what we realize is that what got us here from the 1,000 crore to 5,000 crore journey, the next journey will not, by doing the same things, will not go to the next level. And I think what we have undertaken is what we call a 5-year transformation journey. And what we have identified is 5 areas where we need to be top quartile amongst all global CPG players. And the approach is very simple. We have painted a picture of what this organization is going to be like, in say 18-19, whether it's we do it in 18-19 or 19-20, that 10,000 crore mark. But what is more important to say is that, can we look future backward and work towards a kind of a milestone in all these 5 areas of transformation identified, and make it a best-in-class CPG company. And our approach is that if you do the right things, automatically the outcomes will happen.
One of the biggest areas of weakness has been what is happening in rural India, where rural inflation continues to persistently be higher than urban inflation, thereby denting consumer sentiment in rural India. And we've seen the kind of impact that has also had on Marico's results, as well as a lot of other FMCG companies as well. But as you take realistic stock of the situation, how far do you think recovery is?
What has happened in the last 6 months or so, I think there are 2 issues. I think one is that obviously there is a bit of a crunch in rural liquidity. And number 2 is, I think what has also happened is the fact that in the sense that there was a sort of a certain momentum which was there, the base effect has come into being. So yes and no. I believe, given the fact that input cost situation is an all-time low, this gives us an opportunity for all FMCG companies to actually drive a sort of, in terms of pass on the benefits to the consumer in terms of pricing, also drive innovation in terms of increased advertising inputs, and actually kickstart consumption. Having said that, we believe that the urban consumption recovery is going to happen perhaps earlier than rural. Rural is a wait and watch, because also some parts of the country has suffered 2 consecutive years of drought. So that is a factor to come to it. But having said that, I think, are we too worried about it? The answer is not really, because I think this is a great opportunity for a lot of FMCG companies to actually take certain pricing calls aggressively. Don't look at short-term margins, but ensure that these is plowed back into both driving affordability, driving distribution, and driving innovation.
Well, you talked about an aggressive pricing strategy, and we know that Marico has decided to take price cuts and buy market share as well as volume growth, and this is going to be your strategy going forward. But right now, Marico benefits from benign commodity prices, as well as the fact that you already have leadership positions in many of the segments that you operate in, as well as the fact that you have sophisticated pricing models as well. But how long can it be sustainable?
I think what we are trying to do essentially is to drive these price cuts to get the momentum and kickstart the consumptions. We do have obviously also innovation to drive the growth, but at the same time pricing as another lever to drive the growth. I think what we are looking at, and if you look at the entire sector, is that earlier people and a lot of players before 2012 were delivering double-digit volume growth, 10 to 12. Can we get the 6% which we have been doing to 8 and gradually to 10? Once we do that, I think the momentum will take care of itself. Having said that, yes, I think we have been, the sector has been lucky enough to go through a kind of a deflationary phase in terms of input costs. How long will that last? At least we see at least especially with crude, of course, very difficult to predict, but I think we can see at least a 9 to 12 month cycle where things will continue to be soft. And we are hopeful that in the second half of the year and going forward in 2016-17, things like pay commission, the OROP implementation, that those will also drive a little bit of consumption.
Let's talk about some of your segments as well, and I want to touch upon Saffola. Now, Saffola has been underperforming, and in your latest quarter also, you've seen a growth of just about 4%. Earlier as well, you've said that you would like the Saffola portfolio to contribute a lot more to your revenues. Why is it that efforts at innovating in the Saffola portfolio is not paying off? What are you going to do to cause or to bring about an uptick in demand as far as the Saffola portfolio goes?
So absolutely right. I think we have been having a disappointing results with Saffola, and what we have been doing, the easiest one obviously is to do a price cut. But I think that is not the entire story, because at the end of the day you have to invest behind the brand, because Saffola is a brand which needs investment. It's a brand which a certain set of people who are health conscious, who move into this brand. And what we have done in over the past 5 to 7 years is, if we look at, say 5 to 7 years ago or 10 years ago, it was a very therapeutic brand. It has moved from therapeutic to a pro health or a pro, a preventive kind of a brand. Having said that, again, I think two things happened. One is obviously there's an affordability point of view. Number two, what had happened is that there was another issue of we getting squeezed from both the entry point level through some brands and at the top end through certain other species of oil. So we haven't done innovation at the top end, which we have to do. But I think the second thing which was happening was we were attracting a set of consumers who were pro health, were also consuming less oil. And I think we were not getting a set of consumers who wanted to have a healthy life, but the brand was seen as too pro health and a niche for them. So we were not playing all the entire variants. So one of the things which we have done, started the processes, is that one we have done is selective price cuts. We have not done across the board price cuts because we need to protect a certain level of margin. Secondly, what we have done is we have started pushing some of the other entry point variants of Saffola, which are the affordable Saffola, and that should drive a volume growth. We are fairly confident of a much better performance in the second half of the year. I think we wanted to do a lot of experiments. We tried 4-5 things. Some worked, some didn't work, but at least we now know what is going to work for the next couple of years. And I think at least having said that, yes, we haven't done enough innovation at the top end, which we have to do.
Sure. Now, coming to the Paras acquisition that you made in 2012, and when you acquired brands such as Livon and Set Wet, it's been 3 years, but that portfolio also continues to underperform. And one of the reasons that you have mentioned in your own investor presentations is because of lack of penetration and as well as low investment. So going forward, how are you going to relook at this portfolio, and what kind of investment can we see to drive this particular portfolio?
I think two things happened. When we did the Paras acquisitions in 2012, early 2012, it coincided with the urban consumption slowing down. So therefore, some of the categories in which Paras participated, those categories which were growing at high double-digit rates actually slowed down to single digits. The other thing that happened obviously was that it was not a straight pass. It was with a Reckitt for a year, and this was a low-focus brand because they obviously intended to sell that part of the business. So there was erosion of brand equity during that time. And obviously what happens, so the last 2 years before we got the brand, there was some erosion of brand equity because there was not enough long-term investment behind the brand.
Sure.
So what we did was, and I think that was something which we perhaps in hindsight didn't do well. There were 3 essential, the franchises. There was a Livon franchise which was into hair fall and serum. There was gel and there was deo. Now in both serum and in the gel, we were market leaders, but the category penetration was low. So therefore, we ideally should have investment behind growing those categories where we are market leaders. As market leaders, it is our responsibility to grow these categories. Instead, perhaps we picked up in the more exciting category, which is deo, which was very highly competitive. It was cluttered. The investments required is higher. And actually amongst the 3, it has the lowest margin also. And we put all our investments behind trying to grow deo market share. And there was an innovation disruption that happened in the fog. The category changed from gas to no gas. As a process, those 2 years of investment didn't give us the yield. So fortunately, we have started doing the course correction. So first we started driving gel, which we started off sometime last December. Gel is growing. We have now started the serum journey. We have a much improved product. We have gone into an LUP. One of the reasons of success of gel was driving the 10 rupee price penetration.
Lower SKUs. Okay.
So we have started the same thing with Livon.
Correct.
And also in Livon Hair Gain, which is a hair fall product, we faced a lot of counterfeit, which we have currently corrected and taken certain measures.
Correct.
So we believe that if we can get the two segments back into growth phase, automatically the entire portfolio will start growing. Dio is on hold. I think what we need to do is at the end of the day, we have to maintain this where we are.
Sure.
And perhaps we are planning some renovation on the brand sometime in the near future.
Absolutely.
In the next couple of months.
But when you say Dio will be on hold, are you trying to say that there will be no further investment that will go into the Dio category?
No. So what we are saying is that unless we do some renovation on the brand, because in a Dio category needs some kind of a differentiation to drive the growth.
Okay.
And therefore there is no point investing behind it. In any case, it's under the same brand set weight as long as we invest behind. So we are looking at a much more larger frame of male grooming as opposed to saying that this is for gel styling and this is for Dios. So we are looking at an umbrella male grooming brand like Setwet, and as long as we advertise Setwet, it will have a rub off on Dio.
Sure. Coming to value added hair oils, a very innovative segment by Marico. But the real issue is that today when you look at the portfolio that you have, and it is a high margin category, but the margins are not as high as that of your competitors like Imami and Dabur. Why is this the case?
See, I think the way to approach it is that we have been growing market share both in value and volume terms. We have a much more broader participation strategy. We don't participate in one single segment. And if you see the past, the sub-segments were species-based or seed-based. I think we have moved it to more consumer need-based, because what people look at this category is a fine balance between sensorial and nourishment.
Correct.
And so what we are looking at, and within that there is also specificity of problem solution. For example, we believe hair fall, which is a 900 crore market, is a very attractive market. We participated in selectively in the south, but now we have a product which we have just test marketing, prototyping in the west. We believe it has huge potential.
Sure.
Similarly, we have found out another way, is mustard is a huge pool in some of the North Hindi speaking markets.
Right.
So our strategy is a much more broader participation strategy. And the way to look at it is that we straddle across different price points. So you might have a Shanti at the bottom end of the pyramid, but you have a hair and care or tomorrow something which is a premium hair oil which will be at the top of the pyramid. So we want to straddle and play across the entire pyramid. And our endeavor is that how do we in the next 3 to 4 years move our volume share from currently 30 to 40 and our value share, which is 22 to 23, at around 30, 32. So we are definitely looking at both volume share and value share moving in tandem. Now as far as margins are concerned, I think we have to look at what is our operating margin, and we have said that as long as our operating margin for the entire group is within 16 to 17% as kind of a threshold, we will maximize volume and we will maximize market share gain.
We'll slip into a short break now. Do stay with us. Welcome back. You're watching the CNBC TV 18 special interview with Mr. Saugata Gupta, the CEO and MD of Marico India. Marico has adopted an incubation model to prototype hair and skin products, and this is part of your endeavor to grow the portfolio as well. What I understand is that Marico is looking to pick up a significant stake in a startup. Can you share with us what the startup is likely to do and how it will help you in your endeavor? Do you have any specific targets that you can share with us?
I think we wanted to invest in, we have put in some investment behind this salon. This is a skincare range which sells into the salon segment and more at the mass end of the salons. We believe that this segment is a key influencer salons today in terms of consumer habits of adoption of hair care products. Also it can be used as a access to this segment gives us also some kind of a foothold in terms of doing consumer inciting, test marketing new things.
Sure.
This company where we have invested, put a strategic investment in, is manufacturing skincare products for this segment. We believe there could be a portfolio in hair also which we can plow back in. So it's just an experiment. We have just made a strategic investment.
Also, we understand that Marico has now set up a merger and acquisition strategy cell, and you recently appointed Mr. Pankaj Saluja as the head of that M&A cell, which is directly reporting to you. Over the next few years, what is your inorganic strategy going to look like? Is it going to be a series of small strategic investments like the one that you just talked about, or would you perhaps also look at something as big as like the Paris acquisition that you did in 2012?
I think as far as M&A is concerned, I think one part which we have talked about is making a series of perhaps strategic investments into adjacencies, which will help us in our core business and achieve our long-term aspirations. As far as M&A the other part is concerned, I think we have now made a series of M&As in both international markets and I think in India. We have learned we have a lot of learnings from there, and we believe that while the past inorganic was a key driver of growth in the international business, we have sufficient scale, and now that we have one Marico, we have unified the India international business. The first thing which we tried to do is how do we build capability in the international business for organic growth, because we believe that inorganic can't be an escape button for not doing organic growth, and inorganic is a more of a accelerator of growth and not a means to grow. And I think we didn't realize the full potential of the entire cross-pollination or the synergies which we have in each of our businesses in our different markets which we have. So I think in the last 2 years we have done a lot of what I call course correction, building the foundation for the international business to develop capability for sustainable, predictable organic growth. We now believe there are opportunities. We have to also de-risk our business. There is some concentration of profit pool in certain markets, and therefore there are certain markets in both Southeast Asia, it could be in South Asia and in East Africa, where there could be opportunities for what I call inorganic opportunities for growth, which we will look at it.
Okay, so are there specific geographies that you have looked at which in East Africa that you would want to get into in perhaps the next fiscal year? Or
I think if there are opportunities, as I said, in both we are looking at development, emerging markets of Southeast Asia and East Africa as the first phase. Now there could be certain opportunities even in an existing market which either gives us dominance or scale up, because at the end of the day, I think we need to also ensure that each of these hubs where we have a management bandwidth and a system and a distribution bandwidth, how do you realize the full potential of that? And in a lot of our markets, we are in one pillar, which is basically either male grooming or hair nourishment. I think it's important that we get into both and perhaps look at some adjacencies. For example, skin is an adjacency.
But since we're talking about international markets, I should touch upon your international business as well, which has also recently been under a bit of a slowdown, especially because your largest market, Bangladesh, has been underperforming. Is this, what is your forecast over how your forecast on your international business for the next few quarters? Do you see that correction taking place immediately, or do you think that recovery is still a bit far away?
So as far as I think there were issues, I think there were multiple issues across multiple fronts. Okay, so I think that one of the reasons I think our international business had not been performing well. What we were doing is we didn't want any short-term fixes. We wanted a long-term fix, and the long-term fix means a correct portfolio with a right to win, getting the GTM in place, getting the cost structure right, getting processes, systems and talent. And to me, once you do that, then you can have a repeatable model of growth, which is a sustainable, profitable growth. And we have been getting those things right. As far as Bangladesh, which you have mentioned, I think specifically, there was an issue because our huge dependence on one particular parachute coconut oil, which was, which is 80% market share. The loose to branded has also been 80%. I think that had led to a kind of a saturation. So therefore, we had to, I think, diversify our portfolio aggressively, which we didn't do. And the reason was that I think in our earlier structure, where international business was a separate profit center, Bangladesh was almost like a cash cow to the entire business, and therefore it was to an extent, perhaps in hindsight, cross-subsidizing. We hadn't invested, so we are getting into the investment mode now. The point is that still parachute contributes to maybe 85% of the total portfolio. Now to get that, and that is saturated, it can't grow beyond
there's no headroom to grow anymore.
But at the same time, there could be opportunities to grow. Now to get the 15% to grow at 40 to 50%, you need that right portfolio. That takes a little time. I think what we are doing is we are being patient about it. In some of the cases, the recovery has taken perhaps a couple of quarters more than it should have. But having said that, yes, I think we are pretty more confident that, international business, at least, in the next couple of quarters, getting back into growth and delivering 10% plus constant currency growth. It's very much eminently possible, because I think a major part of the course correction is over. And having said that, I think we are far more confident about the second half in terms of international business getting 10% at least to start off with, and then progressing towards what is our aspiration of a 15% constant.
It's also important for us to touch upon, the growth of private brands in India. For example, one of the brands that is most talked about today is Patanjali products. Today, it's grown to become a 2,500 crore rupee brand, competing with some of the biggest MNCs in India. Do you think India has come to that stage where these private brands are now going to have a bigger play in the consumption pie in India, and that perhaps, MNCs will really have a tough fight in terms of protecting their market share as well as protecting their consumer base?
See, I think if you really look at it, most of the categories, there is enough headroom for growth and penetration, which is low. The way to look at it is that, I think, and the other interesting thing is that today there is a convergence as far as the aspiration from the rural and the urban consumer is. A lot of people at the bottom of pyramid are looking at the same aspirational brands. It's the outlay which they look at, smaller outlays. Okay, so as long as you continue to innovate and drive better availability and affordability, I think it's a level playing field.
All right. Thank you so much for speaking to CNBC TV 18. We really appreciate you joining us today. Thank you for watching.